Welcome to the Deep Dive, the show where we take complex stacks of research and notes and, well, we extract the most important nuggets of knowledge for you. Today, we're tackling a foundational pillar of global finance. It's a topic that is notoriously dense, but absolutely essential for personal and business security: life insurance. Most people, I think, view it as simple paperwork, right? A basic contract for protection.
Yeah, just something you sign and forget about.
Exactly. But if you truly drill into the source material, the history, the math, the law, you find this massive engine of statistical science and really sophisticated capital management. Our mission today is to give you that shortcut, the deep dive into that machine. We are going to unpack the historical roots of assurance, dissect the specific mechanics of the contract,
Right.
things like the insurable interest requirement.
Which is fascinating, by the way.
It is. Then we'll reveal the statistical science of pricing, the whole actuarial engine, and finally explore the surprisingly varied policies available, from, temporary protection all the way to permanent investment vehicles.
It's an indispensable exploration. And I think we have to start by defining what it even is, because the definition itself has expanded over centuries.
Okay, so ground zero, what is it?
At its most fundamental, life insurance is a contract. It's between the policy owner and the insurer. The insurer, or assurer, promises to pay a specific sum, that's the death benefit, to a designated beneficiary.
Upon the death of the insured person. Simple enough.
In theory. But what's fascinating here is how the scope has broadened. The contract can also trigger payment due to events like terminal or critical illness.
Ah, so not just death.
Not just death anymore. And in the broader business context, many modern life insurers operate almost like the asset management industry. They often offer and administer retirement products, like annuities, positioning themselves as facilitators of capital growth and long-term savings, not just risk mitigators.
To understand that modern complexity, we really have to look back at the origins. And what stands out immediately is that the science of life insurance didn't begin with finance.
No, not at all.
It began with communal survival and, frankly, the high cost of dying.
Absolutely. The earliest traceable precursors date back to ancient Rome. We're talking about the Roman burial clubs, the Collegia Teniorum, which were established around 133 AD.
So these were like mutual aid societies.
Exactly. Members contributed regularly, and the central purpose was to ensure that upon a member's death, the family received enough money to cover the often prohibitive cost of a proper Roman funeral.
And provide some assistance after that.
And financial assistance to the survivors, yeah. It was really the first true model of communal nonprofit risk pooling for mortality.
And what's truly remarkable is that even back then, the Romans moved beyond just guesswork. Our sources point to a critical early actuarial effort.
The Severan Dynasty-era life table, compiled by the renowned jurist Ulpian around 220 AD.
A life table in 220 AD.
That table is foundational because it shows a structured, if maybe a bit primitive, attempt to quantify life expectancy based on age. It wasn't derived from huge statistical pools like today, obviously, but it was used for estimating the value of lifetime legacies and annuities.
And the fact that this specific table was later included and preserved in that huge legal codification, the Digesta Seu Pandectae, in 533 AD.
Yes, ordered by Emperor Justinian I.
It just shows that mortality calculation has been interwoven with legal and financial planning for what? Almost 2 millennia?
It's been part of the legal framework for that long. It's incredible.
So we fast forward over 1,000 years, and the concept moves from this general communal risk to very specific high-stakes mercantile contracts. This is where we get the dawn of the modern policy.
The precise birth date is June 18, 1583, at the Royal Exchange in London. This is the earliest known written policy we have.
And the transaction itself is a perfect snapshot of risk transfer, isn't it?
It really is. You have Richard Barton, the policy owner, who paid £30 to 13 different merchants. In return, those merchants collectively promised to pay £400 if the insured person, a man named William Gibbons, died within the next year.
So it was essentially a one-year term policy underwritten by a syndicate of risk takers.
A wager, really.
Yeah.
A wager on a specific life, but it paved the way for institutionalizing the business. And the first true company dedicated solely to this came about in London in 1706, the Amicable Society for a Perpetual Assurance Office.
Okay, the Amicable Society. How did they operate?
They started with 2,000 members, and they moved away from those individual wagers and formalized the pooling mechanism.
Yeah.
Everyone, as long as they were between the ages of 12 and 55, paid an equal annual contribution.
So they didn't calculate risk based on age. A 12-year-old paid the same as a 55-year-old?
Correct. They simply divided the total contributions, minus expenses, of course, among the families of all deceased members each year, proportionate to the shares they owned.
So if many members died, the payout per family was smaller.
And if few died, the payout was larger. It was a mutual society designed to smooth out financial volatility for the survivors.
But that inherent volatility, the payout depending on the number of deaths that year, that's precisely what the next great leap solved.
It is.
Here's where it gets really interesting, because we transition from clubs and pooling to actual scientific mathematical practice.
The critical shift that enabled modern life insurance was the creation of the mathematical tools to actually predict future mortality rates for large groups. And that foundation was laid by Edmund Halley.
Wait, Halley as in the comet?
Yes, the astronomer known for the comet. He wrote the first scientifically derived life table in 1693 based on death records from Breslau, Germany.
The genius of Halley was that he wasn't just counting dead people. He was analyzing the population at different ages to estimate the probability of survival from one birthday to the next.
Right. And that moved insurance from pure gamble to a calculated business.
And that calculation was then institutionalized by the Society for Equitable Assurances on Lives and Survivorship.
Established in 1762 by Edward Rowe Morse, who was mentored by the mathematician James Dodson. It was the world's first truly scientific mutual insurer.
So what was the big innovation they introduced that sets them apart from the Amicable Society?
They pioneered age-based premiums. They recognized that a 20-year-old posed far less risk than a 50-year-old and therefore should not pay the same rate. It seems obvious now.
But it was revolutionary then.
Absolutely. By introducing premiums derived directly from Halley's mortality rates and adjusted for age, they established the entire framework for scientific insurance practice that we still use today.
Yeah.
They ensured fairness by making the premium proportional to the statistical risk being insured.
And in a wonderful piece of etymological history, Morse solidified the scientific connection by giving the name actuary to the chief official responsible for these complex calculations.
That's right.
That title signaled this wasn't mere bookkeeping or sales. It was the mathematical gatekeeping of fairness and solvency.
Exactly. And the first person to hold that formal title was William Morgan. He served for decades, overseeing the use of regular valuations to ensure the society was solvent and that its accumulating reserves were sufficient to meet future death claims. He was balancing the competing interests of current and future policyholders.
Okay, so transitioning from that history to the present, let's look at the contract itself. It is a dense legal document, and it defines very specific roles, rights, and limitations.
And it's crucial to clarify who does what, because the insured person is not always the main party to the contract.
Right.
So we have to distinguish between three main roles. First, the policy owner. This is the person or legal entity, could be a trust, a corporation, that holds the rights of ownership. They are responsible for paying the premiums.
And they're the only one who can touch the cash value or change the beneficiary.
That's right. They're the only party who can access the cash value or change the beneficiary designation, provided it's not irrevocable.
Okay, then there's the insured.
The insured. This is the person whose death triggers the payment. For clarity, we'll just call them the insured.
And finally, the beneficiary.
The beneficiary. They receive the proceeds upon the insured's death, and this is a critical point. The owner designated them, but the beneficiary is not a party to the contract.
Why is that so important?
Because the owner can typically change the designation at any time unless it has been explicitly made irrevocable. If it's irrevocable, the beneficiary has a vested right in the policy. That means the owner cannot change the beneficiary, borrow against the policy's value, or assign the contract without that beneficiary's signature.
That clarity on rights helps explain why the contract needs certain structural limitations, specifically exclusions. What are the most standard ways an insurer limits its liability?
Well, every contract includes common exclusions. Death by suicide within a certain period, usually 2 years. Fraud in the application. And deaths resulting from war, riot, or civil commotion. These are all designed to prevent people from purchasing insurance with an immediate intent to exploit it, or from insuring against catastrophic, unquantifiable group risks.
And where do the sources highlight the difficulty in defining these events? Because war seems clear, but...
Well, the difficulty arises when an event is not clearly defined or intentional. Say the insured dies from complications following a highly experimental medical procedure that wasn't clearly excluded in the fine print.
Mm.
Or what if the insured was killed while traveling through a region that was politically unstable, but not officially defined as a war zone at the time? These ambiguities often lead to very complex legal battles between the insurer and the beneficiary.
And speaking of fraud, the insurer has a limited window to investigate and deny a claim if they believe the policy was obtained through misrepresentation. That's the contestability period.
Yes, in U.S. states, this period is typically a maximum of 2 years from the issuance date. If the insured dies within those 24 months, the insurer can contest the claim based on misrepresentation in the application.
And this could be anything from lying about smoking.
Lying about smoking habits, deliberately omitting a known major medical diagnosis,
Yeah.
anything material.
So if the insurer discovers that misrepresentation, what is their recourse?
They conduct a full investigation. It's often referred to as a post-mortem underwriting review. If they can prove that the misrepresentation was material, meaning if they'd known the truth, they would have charged a higher premium or maybe declined the policy altogether, they can legally void the contract.
And just return the premiums paid.
Exactly. They return the premiums. However, once that contestability period ends, the policy becomes incontestable, and the insurer must generally pay the claim, even if they later discover misstatements. That incontestability clause is a vital protection for policy owners.
The ultimate legal safeguard against outright exploitation, though, has to be the insurable interest requirement. This rule is absolutely fundamental to the ethics and legality of life insurance.
It is essential. It's what maintains the integrity of the contract. The law requires the purchaser, the policy owner, to have a genuine, demonstrable, insurable interest in the insured person.
Meaning you have to stand to lose something financially if that person dies.
Precisely. You must face some real, defined financial loss or detriment. This is often established by relationship. Spouses, children, creditors, business partners.
What's the critical function of this requirement?
It prevents people from purchasing purely speculative policies on strangers. Without this rule, you could profit from another person's death without having any legitimate stake in their continued life. It shifts the incentive structure from risk mitigation to, well, risk creation.
And that's why the sources cite such a disturbing specific legal example, the 1957 case of Liberty National Life v. Weldon. This wasn't a theoretical risk, it was a devastating real-world outcome.
Indeed. In that case, Weldon, the insurer, sold a policy to an unrelated purchaser who demonstrably had no insurable interest in the insured individual. That policyholder subsequently murdered the insured person to collect the benefits.
And the court found the insurer partially liable?
Partially liable for contributing to the wrongful death, yes, because the act of selling the policy to someone with no legitimate interest provided the direct motive for the crime. This case cemented the understanding that the insurer has a social and in some cases legal obligation to uphold the insurable interest rule rigorously.
But the insurable interest rule gets a bit more nuanced when we move beyond personal policies. How does it apply in a sophisticated business context?
That's a great point, especially for business owners. When a company buys insurance on, say, a CEO or a key executive, that's called key man insurance. The insurable interest isn't about family or well-being.
It's about the bottom line.
It's about the financial loss the company would suffer upon the death of that individual, the cost of replacing them, the loss of sales, the disruption to business. The loss has to be quantifiable.
And similarly for buy-sell agreements between partners.
Same principle. Partners insure each other so that upon one partner's death, the surviving partner has the capital to buy the deceased partner's share of the business from the estate. It ensures business continuity. The financial relationship establishes the interest.
That legal and financial risk profile brings us perfectly to the core operational engine of the industry, the pricing engine, or actuarial science. This is where uncertainty is quantified and converted into a manageable premium.
The actuary is calculating how much money the company needs to collect today to cover a death claim that might happen decades from now, while still covering administrative costs and, achieving a profit.
And to do this, they rely on three essential factors.
3 factors: mortality, interest, and expense.
Let's start with mortality. We know they use mortality tables, but how does an actuary actually factor that into a specific premium?
So mortality tables, like the SOA 1975-80, the 2001 VBT, or the 2001 CSO tables, they provide the expected annual mortality rate for a group of people at a given age. This gives us what's called the net premium, which is the amount strictly necessary to cover the expected cost of claims. So if 1,000 40-year-old males are expected to suffer 3 deaths this year, the total claims divided by 1,000 policyholders gives you the net premium per person.
And what's the significance of those acronyms VBT and CSO? Are they the same tables?
They serve different specialized purposes. The VBT, or Valuation Basic Table, and the CSO, the Commissioner's Standard Ordinary Table, are critical for regulatory compliance in the U.S.
So this is for the government.
This is for the regulators.
Hmm.
The CSO table specifically sets the minimum reserve requirements that insurers must hold. In short, the industry uses these tables to prove to regulators that they are reserving enough money to pay future claims. They often use slightly different proprietary tables internally for actual pricing, but the regulatory tables set the floor for financial solvency.
So mortality determines the chance of a payout, but interest, the second factor, is perhaps the most counterintuitive part of the calculation. Why does the expected return on the money matter so much when pricing a life policy?
Because life insurance is inherently a long-term contract. The company isn't just holding your premium in a shoebox.
Right, they're investing it.
They're investing it for perhaps 40 or 60 years. Therefore, the premium is reduced by the expected interest the company will earn on that invested money over time. This is the interest assumption.
So if they expect to earn more, they can charge me less.
Exactly. If an actuary assumes they can safely earn 4% interest per year, they can charge you a much lower premium today than if they only assumed 1% interest.
And the third factor is the expense load. This is simpler but necessary.
Yes. The net premium, which is mortality minus interest, only covers the claims. The gross premium, which is what you actually pay, includes the expense load, overhead, commissions, taxes, administrative costs, and the company's profit margin.
So gross premium equals net premium plus expense load.
That's the formula. Understanding it shows you that the premium is not solely based on your personal risk. It's a three-pronged calculation mixing biology, finance, and overhead.
Now, before an actuary even applies those tables, you have to go through underwriting. This is the evaluation of your specific risk profile.
And this is usually skipped only for basic group policies. The underwriter's job is to place you accurately on that mortality curve. They scrutinize everything: personal medical history, family medical history, especially early onset diseases.
Driving record, BMI.
Driving record, the height and weight matrix, yep. They are trying to find the anti-selection risk. Meaning, are you trying to buy insurance because you know something about your health that the company doesn't?
To streamline this, insurance companies rely heavily on shared data, which brings us to the MIB, the Medical Information Bureau.
The MIB is a crucial clearinghouse supported by U.S. life insurers. If you apply to a participating company, information about what you disclose or what the medical report finds is submitted to the MIB and kept on file for 7 years.
So when I apply to a second company,
That company cross-references your application against the MIB data. If you claimed you never had high blood pressure in the first application, but you omit that fact in the second, the MIB record flags that inconsistency.
that sounds like a powerful way to manage fraud, but it also raises some ethical questions about data sharing among competitors.
Well, it exists specifically because of the high financial stakes and the incentive for anti-selection. The MIB prevents people from applying to multiple insurers and consistently misrepresenting their health, which helps maintain the integrity of the risk pool. However, the data shared is coded and aggregated, not your full medical file, to remain compliant with privacy laws.
And the pace of this whole process is accelerating thanks to technology. The sources mention automated life underwriting. What does that look like in practice?
For smaller face value policies, especially term policies, automated systems can now perform many of these traditional screening functions almost instantly. They pull electronic data, check prescription drug histories, run MIB cross-checks, and apply algorithmic scoring to the application questions.
Which has compressed the issuance time from weeks or months.
Down to minutes in some cases. It's especially important for digital sales platforms.
Once all that data is collected and screened, the underwriter places the applicant into a category that determines the final premium rate. Let's detail the standard 4 tiers.
The baseline is the standard category. This is where most people fall, representing the average risk for their age and gender.
Then you have the preferred tiers, which get the steepest discounts. Preferred and preferred best.
Preferred best is for the statistical elite. Pristine medical history, no family history of premature death from certain diseases, perfect BMI, excellent lifestyle factors. Preferred is for those who are still very healthy but might have a minor issue, like controlled cholesterol or a slight family history that prevents them from achieving that top tier.
And finally, the highest risk tier, requiring the highest premiums.
Tobacco. This category includes regular smokers and sometimes even those who use nicotine products like vaping or chewing tobacco.
And the numbers vividly illustrate why these categories exist and why pricing is so sensitive to age.
It's dramatic. If we compare the first-year mortality rate for a preferred best non-smoking 25-year-old male, the rate is minuscule, approximately 0.35 deaths per 1,000 policyholders.
Very low.
Very low. But if you look at a non-smoking male at age 65, that mortality rate jumps to approximately 2.5 deaths per 1,000.
That acceleration is really what drives the cost. Mortality approximately doubles for every additional 10 years of age past 40.
That immense increase in risk means the 65-year-old must pay many, many times the premium of the 25-year-old, even for the same face amount, just to maintain the net premium balance.
And we have to conclude this section with a crucial reality check. While life insurance is a social good, it remains a commercial enterprise.
Insurers are never legally required to provide coverage to every applicant in the U.S., provided they adhere to Civil Rights Act compliance.
So if the underwriter deems the risk too high,
They have two main options beyond the standard rate. They can rate the policy, which means they accept the applicant, but increase the standard premium by a percentage at table rating to compensate for the elevated risk.
for something like a controlled but serious medical condition.
Exactly. Or, if the risk is deemed too severe, they could be declined coverage entirely. Selective risk acceptance is, ultimately, what keeps the entire pool financially viable.
So once the applicant is insurable and the premium is set, the choice of policy structure determines the long-term financial role the insurance plays. And we can divide this into two fundamental buckets.
Temporary protection and permanent growth.
Or protection policies and investment policies.
That's right. Protection policies, primarily term insurance, are designed for a specified occurrence, death within a defined time frame. Investment or permanent policies facilitate capital growth alongside that death benefit.
Let's start with the basic mechanism, term insurance. It's the cheapest, simplest form of protection.
Term insurance provides coverage for a specified duration, usually 10, 20, or 30 years. The primary advantage is its cost. It's significantly less expensive than permanent policies because the insurer knows, statistically, that most people will outlive the term.
Meaning the insurer will likely never have to pay the claim.
That's the bet they're making.
The disadvantage, then, is the flip side of that coin. It doesn't accumulate any cash value.
None. If the insured outlives the term, the policy just expires. You've paid for protection for a period and you receive nothing back, which for many people is the most efficient way to cover specific temporary needs, like the years spent raising children or the duration of a large mortgage.
And within term, we see specialization. You mentioned mortgages. There's mortgage life insurance.
It's specifically designed to cover a loan secured by real property. What distinguishes it is the face value. It declines over time, mirroring the decreasing principal balance of the mortgage.
But the premium usually stays level.
Usually, yes. The payout always matches what's left on the loan, ensuring the debt is cleared.
Then there is group life insurance, which covers a collective entity, often an employer's workforce.
Group life is critical because the underwriting mechanism changes entirely. Instead of individual underwriting, the insurer assesses the risk of the group as a whole, considering its size, employee turnover, financial stability.
Which means that members, particularly those with maybe minor health issues who might struggle to get individual coverage, can get covered.
They receive coverage with minimal or no individual medical qualification. This is a massive social benefit provided through employment.
Okay, moving to the second major class, permanent coverage. This is where the policy truly operates as a sophisticated financial product, combining death benefit protection with an investment component.
Permanent life insurance provides coverage for the remaining lifetime of the insured, assuming premiums are maintained, and it accumulates a cash value. This cash value is mathematically separate from the death benefit, and it allows the policy to act as a savings mechanism.
And how does the owner access this cash value?
The owner has significant flexibility. They can withdraw funds, although withdrawals may reduce the death benefit. They can borrow against the value, often at competitive rates, using the policy as collateral.
Or they can just surrender the policy entirely.
They can choose to surrender the policy, terminate the contract, and receive the surrender value, which is a cash value, minus any surrender charges.
The two core permanent types are whole life and universal life. Let's look at the traditional guaranteed product first, whole life.
Whole life provides lifetime coverage with a guaranteed set premium that never increases, regardless of your age or health. It also guarantees a minimum interest rate on the cash value accumulation. It is the gold standard for guarantees.
The trade-off is that premiums are significantly higher initially than term.
Much higher. And its cash value growth tends to be slow and predictable.
Then we have universal life, or UL, which trades all those guarantees for adaptability.
UL is designed for maximum flexibility. Both the premiums and the death benefits are flexible. The crucial mechanical difference here is how the cash value is built and maintained. Unlike whole life, where the premium is bundled, in UL, the contract specifies three moving parts: interest credited to the cash value, administrative expenses, and the cost of insurance, or COI.
And that COI is the key to UL's potential volatility, isn't it?
It is the most important element. The COI is the actual cost of mortality for that year, and it increases annually as the insured gets older. The premium you pay is credited to the cash value, and then the COI and expenses are deducted monthly.
So if your cash value accumulation driven by premiums and interest falls below the level needed to cover that accelerating COI,
The policy can lapse. The owner has to constantly monitor and potentially increase premium payments later in life to keep the policy solvent. It's a major distinction from guaranteed whole life.
Now, regarding the death benefit flexibility, the owner typically chooses between two options when setting up a UL policy.
Yes. Option A provides a level death benefit. The face amount remains constant. As the cash value increases, the net amount at risk for the insurer actually decreases, which leads to lower COI charges over time and typically lower premiums overall.
And option B.
Option B is the increasing death benefit. It pays the original face amount plus the accumulated cash value and earnings. This means the death benefit grows over time if the cash value increases.
This option requires higher premiums, but it serves better as an investment vehicle.
It does, particularly if the owner expects significant tax-deferred cash value growth.
Beyond these core structures, let's briefly touch on some of the specialized and niche products aimed at specific markets.
We have the endowment policy, which is highly popular outside the U.S. This product is unique because it's structured to pay a lump sum upon death, or after a specific fixed term, the maturity, say 10 or 20 years, whichever comes first.
So it's a forced savings mechanism.
Exactly. It's designed to meet a financial goal, like a child's college fund if you survive, or provide coverage if you don't.
And for those seeking minimal, low-cost coverage, there is accidental death and dismemberment insurance, or AD&D.
AD&D is extremely limited. It covers death only if it results from a defined accident. It specifically excludes death from natural causes, illness, or suicide.
And because the probability of accidental death is much lower.
These policies are significantly cheaper. They often cover loss of limbs or body functions due to an accident as well.
We often see AD&D packaged as a rider, an add-on to a standard policy, correct?
Precisely. If it's purchased as a rider, the policy may pay double indemnity, twice the face amount, if the death is accidental. You might even find triple indemnity coverage. It's a low-cost way to hedge against high-impact, low-frequency external risk.
Finally, there's a specialized market for older applicants, packaged as senior or pre-need products. They're often called final expense or burial insurance.
These are generally low face value whole life policies, aimed at individuals aged 50 to 90. The benefits typically max out around, say, $50,000. Their main selling point is simplified underwriting,
Which is crucial for older applicants who might have minor health issues or just want to avoid an invasive medical exam.
Exactly. And that simplified underwriting works by, instead of a medical exam, the insurer relies solely on a limited set of health questions and a check of the applicant's prescription drug history.
All analyzed through automated systems.
Right. It makes the approval process fast and minimizes the chance of being declined, though the premiums are naturally higher than a fully underwritten policy.
And pre-need life insurance takes that concept a step further by involving the funeral home directly.
Yes. Pre-need life insurance is a limited premium whole life contract where the proceeds are specifically earmarked to fund predetermined funeral expenses, which are designated in a contract with a funeral home.
So the funeral home often guarantees that the proceeds will cover the cost no matter when death occurs.
That's the key. It removes the financial burden and the uncertainty from the family entirely.
Moving to the larger economic and ethical dimensions, we can connect this highly regulated industry to global finance. Life insurance policies, especially the permanent ones, are often used as sophisticated tax planning tools worldwide.
If we connect this to the bigger picture, the tax treatment of life insurance is why high net worth individuals and businesses utilize it so extensively, and the U.S. system provides major advantages based on the structure of the policy.
Let's clarify the U.S. federal tax treatment. Premiums are generally paid with after-tax dollars, correct?
That's right. The premiums are typically not deductible, but the benefit is immense. Death benefit proceeds are generally received by the beneficiary, entirely tax-free for federal income tax purposes.
Okay, that's huge.
It is. Furthermore, and this is the true financial engineering component, the cash value growth within permanent policies is tax-deferred.
And that tax deferral is what allows these policies to act as a significant legally sanctioned tax shelter.
Precisely. The funds can grow year after year without current taxation. This allows for compound growth on capital that would otherwise be subject to annual income tax if held in a standard investment account.
But there is a strict line the IRS draws to prevent the abuse of this system, particularly concerning how much money can be dumped into the policy quickly. And that is the Modified Endowment Contract, or MEC designation.
This is a critical regulatory check. MEC status is triggered when a policy fails the 7-pay test. This test calculates the cumulative premium payments made during the first 7 years of the policy's existence.
And if the premiums exceed the total amount required to pay up the policy within 7 years.
It's deemed to be funded primarily for investment, not for insurance protection.
So what happens if the policy gets designated an MEC?
It loses its main tax advantage concerning withdrawals. While the death benefit remains tax-free, any withdrawals or policy loans become subject to last-in, first-out LIFO taxation.
Which means earnings are taxed first.
Taxed first, and if the policyholder is under 59.5 years old, they may also face a 10% penalty tax on those earnings. This rule exists specifically to prevent excessive tax arbitrage.
Now, if we look at the UK, the tax structure is also designed to incentivize long-term savings.
Yes. Long-term qualifying policies are generally tax-free on the claim. For investment bonds, which function similarly to permanent policies, there's the 5% cumulative allowance. This allows the owner to withdraw up to 5% of the original investment amount each policy year, tax-deferred.
So the actual tax liability is delayed.
Delayed until the bond is surrendered or the final 5% is taken. It's an excellent tool for managing income across different tax years.
And looking toward the developing world, countries like India use tax incentives even more aggressively to encourage personal security.
In India, the government provides immediate tax breaks on premiums. Premiums paid toward a valid policy are exempt from taxable income under Section 80C, up to 150,000 rupees per year. And critically, the entire death benefit is fully exempt from income tax under Section 1010D.
It demonstrates a global regulatory recognition that insurance provides both individual and societal financial stability.
It absolutely does.
Now, let's pivot to the ethical edge. This raises an important question. What happens when the massive financial incentive inherent in the death benefit leads to exploitation or subverts the entire principle of risk management?
The central concern here is subverting the insurable interest requirement. The practice of life settlements, where a terminally ill person sells their policy to a third-party investor, evolved. And this is a legal, regulated practice.
Often called a viatical settlement if the insured is terminally ill?
Right. The insured receives immediate cash, and the investor assumes the premium payments and collects the benefit upon death.
So if that is legal, where does the ethical line get crossed?
It's crossed with stranger-originated life insurance, or STOLE. STOLE is designed specifically to initiate a policy with the intent of selling it immediately to investors who have no insurable interest whatsoever.
So the investors are just profiting from the timing of the death.
Exactly. They've provided no protection or alleviation of financial loss to the original purchaser. It fundamentally corrupts the insurance contract, and many U.S. states have passed laws specifically to prohibit steal-AI transactions.
Of course, the most extreme ethical failure is when that high face value creates a direct motive for criminal activity.
Life insurance can absolutely facilitate exploitation and fraud. The sources cite a chilling case from Los Angeles in 2006. 2 elderly women were accused of taking policies on homeless men.
And they allegedly kept the men alive long enough to pass the 2-year contestability period.
And then, according to the charges, arranged for their deaths to collect the 6-figure benefits. The policy itself became the direct financial incentive for murder.
Finally, we have to discuss the systemic issue of unclaimed benefits. The source material references a 2016 60 Minutes report that brought a huge systemic failure to light. Many beneficiaries simply do not know a policy exists and therefore never submit a claim.
This is a complex ethical dilemma for the industry. Insurers have access to data clearinghouses and tools, including the Social Security Death Master File, that inform them when an insured person has died.
But historically, they haven't actively initiated the search for beneficiaries unless a claim is filed.
That's right.
Why not? If they know the person is deceased, why wait for the beneficiary to contact them?
Well, the legal argument is that the burden of proof rests with the claimant. However, the ethical issue arises because unclaimed benefits over time become a source of profit for the insurer. When state regulators began investigating, they found that millions of dollars in benefits were just sitting there, unpaid.
And that resulted in many U.S. states passing laws requiring insurers to routinely cross-reference their lists against death databases.
Exactly. And make proactive, documented efforts to find and notify beneficiaries. It forces a transparency where previously silence benefited the bottom line.
This has truly been an extensive journey. We've gone from the ancient Roman communal clubs and the early mercantile wagers in London.
All the way to a modern system driven by complex actuarial science, global tax strategy, and continuous ethical scrutiny.
The core lesson for you, the learner, is understanding the contractual fundamentals and the financial structure. The entire global market is underpinned by the actuary's ability to precisely predict group mortality.
So your policy decision has to hinge on whether you need temporary, cost-efficient protection, which is term, or a comprehensive lifetime financial product that combines protection with tax-deferred growth, which is permanent, like whole life or universal life.
And it's so important to remember the difference between the stability of whole life guaranteed premiums, guaranteed cash value growth, versus the flexibility of universal life, which requires active monitoring of that rising cost of insurance to ensure the policy doesn't accidentally lapse later in life.
We've seen that life insurance relies on mortality prediction based on large groups and massive datasets. But here is the final provocative thought for you to mull over. We're moving into the age of hyper-personalized medicine. What happens if rapid technological advancements in genetics, biomarkers, and AI allow insurers to predict an individual's precise lifespan with near-perfect scientific accuracy?
So if that group dynamic breaks down and personalized risk pricing becomes standard, what then happens to the traditional concept of risk pooling, where healthy people subsidize the risk of less healthy people?
Right. If the premium becomes perfectly correlated with your individual genetic code, the social safety net element of insurance essentially vanishes.
Right.
It could potentially price out anyone with less than preferred best DNA.
It raises the ultimate question of whether insurance remains a tool for communal financial security or just a high-tech transaction reserved for the genetically fortunate.
A critical thought to carry forward.
A fascinating and frankly critical thought to carry forward as we enter this new age of data. That's all the time we have for this deep dive. Thank you for joining us.